Welcome to the Finance Wisdom Summaries.
Valuation, measuring and managing the value of companies. Welcome to Valuation, measuring and managing the value of companies, the definitive guide to understanding and driving corporate value. In this summary, we'll distill the core principles from the first 5 chapters of this essential book, providing you with actionable insights that you can apply to your daily life, whether you're an investor, a business professional, or simply curious about what truly makes a company valuable. At its heart, this book argues that sustainable value creation is about generating cash flow at a rate that exceeds the cost of capital. Let's dive into the foundational ideas.
Chapter 1. Why value? Value creation is the primary measure of a company's success in a market economy, encompassing long-term interests of all stakeholders, not just shareholders. Companies that maximize long-term shareholder value tend to also create more jobs, treat employees better, satisfy customers more, and bear greater corporate responsibility. The core principle of value creation is investing capital to generate future cash flows at rates of return exceeding the cost of capital. The combination of growth and return on invested capital, or ROIC, relative to its cost, drives value. The conservation of value principle states that anything that doesn't increase cash flows doesn't create value, such as changing accounting techniques or substituting debt for equity without changing total cash flows. Market bubbles and financial crises often occur when companies and investors forget these fundamental principles, leading to confusion about real value creation. Equity markets, despite volatility, generally reflect intrinsic value and function well even during crises, unlike less liquid credit markets. Focusing on long-term value creation leads to stronger economies, higher living standards, and more opportunities for individuals. Key takeaways. The most crucial takeaway is that true value creation is fundamentally about generating cash flows at returns higher than the cost of capital over the long term. Don't be swayed by short-term metrics like quarterly earnings forecasts or accounting gimmicks, as the market ultimately sees through these. Short-term pressures often lead to decisions that destroy long-term value. A practical example. Imagine you're deciding whether to invest in a new coffee machine for your small business. Applying the core principle, instead of just looking at how much coffee you might sell, revenue, consider your return on investment, or ROI. If the machine costs $1,000 and helps you earn an additional $200 per year after all coffee and maintenance costs, your ROI is 20%. If your cost of capital, what you could earn elsewhere with that $1,000, or the interest on a loan for it is 10%, this investment is creating value because 20 is greater than 10. Avoiding the conservation of value fallacy. If you merely change how you account for your coffee bean inventory, say from first in, first out, FIFO, to last in, first out, LIFO, to make your reported profits look higher, this doesn't actually change how many lattes you sell or how much cash you have. The fundamental value of your coffee business remains the same. The market, your customers, and potential buyers of your business won't be fooled by accounting tricks alone. Chapter 2. Fundamental principles of value creation. Value is driven by a company's ability to generate cash flows at rates of return on invested capital, or ROIC, greater than its cost of capital. The faster a company can grow and deploy more capital at attractive rates of return, the more value it creates. ROIC, revenue growth, and cash flow are mathematically linked. Investment rate equals growth divided by ROIC. This means you only need 2 of these variables to understand the third. Companies with high ROIC should prioritize growth as it creates more additional value. Companies with low ROIC should focus on improving returns before growing, as growth below the cost of capital destroys value. Not all growth is equally value-creating. Organic growth from new products typically creates more value than growth from acquisitions or market share battles. The conservation of value principle dictates that actions not increasing cash flows do not create value, such as financial engineering that merely rearranges claims to cash flows. Risk affects value through the cost of capital and the uncertainty of future cash flows. Diversifiable risks do not affect the cost of capital. Key lessons for listeners. The core message here is the interplay between profitability, ROIC, and growth. Growing for the sake of growth, especially if your business isn't highly profitable, is a recipe for destroying value. Instead, focus on efficient capital deployment. Also, remember that financial maneuvers are only valuable if they genuinely increase future cash flows or reduce their risk, not just reshape them. Practical example. Consider two imaginary lemonade stands, Value Inc. and Volume Inc. Both start with $100 in initial earnings. Both grow their earnings by 5% per year. Value Inc. is super efficient. For every $5 increase in earnings, it only needs to reinvest $25. Its ROIC is 20%. $5 earning increase divided by $25 investment. Volume Inc. is less efficient. For the same $5 earning increase, it needs to reinvest $50. Its ROIC is 10%. $5 earning increase divided by $50 investment. Even though both grow earnings at the same rate, Value Inc. generates more cash flow because it reinvests less. If your cost of capital, what investors expect to earn, is 10%, Value Inc. is worth $1,500, while Volume Inc. is only worth $1,000. Lesson: if you're running a lemonade stand with high ROIC, focus on opening more stands, growth. If your ROIC is low, focus on improving your current stand to be more efficient, improving ROIC before expanding, because expanding an inefficient business just destroys more value.
Chapter 3: The Expectations Treadmill. Total returns to shareholders, TRS, combines share price appreciation and dividends. Over long periods, 10+ years, TRS reflects actual company performance. Over shorter periods, less than 10 years, TRS can be heavily influenced by changing investor expectations, leading to the expectations treadmill. The expectations treadmill means that a successful company must continually exceed market expectations to maintain or improve its TRS, even if it's already a high-performing company. TRS decomposition reveals 4 components: revenue growth, investment for growth, changes in investor expectations, PE changes, and financial leverage. Strong operating performance, high ROIC, and growth is the true long-term driver of value, but short-term TRS can be boosted by rising expectations or high financial leverage. Managers of companies with high market valuations based on high expectations might be tempted to take misguided actions, for example, risky acquisitions, to meet those expectations, potentially destroying long-term value. Understanding expectations is crucial. Consistently outperforming the market often leads to future TRS declines even with continued strong performance, as high expectations are already priced in. Don't confuse short-term stock market performance with real value creation. A company can be a great business, but a poor short-term investment if its stock price already reflects overly optimistic expectations. Focus on actual business performance that drives long-term cash flow rather than chasing elusive short-term stock gains. Practical example. Consider 2 retail giants, Walmart and Target. From 1995 to 2005, Walmart actually outperformed Target in both revenue growth and ROIC. However, Target's shareholders earned a significantly higher TRS, 24% versus 15%. Why? Because in 1995, the market had lower expectations for Target, lower PE due to struggles with some of its brands. As Target successfully turned its business around and beat those low expectations, Its PE increased substantially, boosting its TRS. Walmart, already a high performer with high expectations priced into its stock, had to consistently deliver against those expectations just to keep its stock price stable, making it harder to generate a high TRS, even with excellent underlying performance. Lesson: for your career or personal investments, know when expectations are already very high. Achieving great results in an area where little is expected can lead to disproportionately positive outcomes, while exceeding expectations when they are already astronomical can still feel like a letdown.
Chapter 4. Return on Invested Capital. Return on Invested Capital, ROIC, is a critical driver of value, reflecting a company's ability to generate profits from its capital. ROIC is influenced by competitive advantage, which stems from industry structure and competitive behavior. Competitive advantage arises from 5 sources of price premium: innovative products, quality, brand, customer lock-in, and rational price discipline, and 4 sources of cost and capital efficiency: innovative business method, unique resources, economies of scale, scalable product or process. Sustainable ROIC depends on the length of product life cycles, the persistence of competitive advantages, and the potential for product renewal. Empirical analysis shows median ROIC has been stable at around 10% in the US over decades, but varies significantly across and within industries. High ROICs tend to persist over time, especially for companies with strong competitive advantages like patents and brands. Key lessons for listeners. Profitability isn't accidental. It's built on clear competitive advantages, and understanding these advantages in your own work or investments is key. Ask yourself, how does this company make money that others can't easily replicate? Or, what unique aspect allows this company to charge more or operate more cheaply? Practical example. Think about the difference between a custom software development company and a company selling a widely used off-the-shelf software product like Microsoft Office. The custom software development company might have good margins on each project, but its scalable product or process is low. Each new project requires significant new labor and development, limiting its ROIC. Microsoft Office, on the other hand, benefits from increasing returns to scale and customer lock-in. Once you buy Office, you're unlikely to switch due to compatibility needs, lock-in, and adding new customers costs Microsoft very little, scalable product or process. This allows Microsoft to maintain very high margins and ROIC, leading to significant value creation over time. Lesson: when evaluating a business, look for those with a scalable product or process or customer lock-in. These are often the true drivers of sustained high profitability, ROIC.
Chapter 5. Growth. Growth creates value only when the new investments generate returns on invested capital, ROIC, greater than the cost of capital. Revenue growth is driven by 3 main components: portfolio momentum, market segment expansion, market share performance, and mergers and acquisitions, M&A. Portfolio momentum, entering fast-growing product markets, and M&A explain more of the differences in growth for large companies than market share gains. Growth driven by general market expansion and creating new markets through innovative products tends to create the most value. Gaining market share from rivals through incremental innovation or price promotion in stable markets rarely creates significant long-term value due to easy retaliation. Sustaining high growth is extremely difficult, especially for large companies, due to natural product life cycles and the challenge of continually finding new, large product markets. High growth rates decay quickly. Even the fastest-growing companies tend to revert to below 5% real growth within 10 years. Companies entering the Fortune 50 often see dramatic drops in their revenue growth rates after entry. Key takeaways. Not all growth is good growth. Understand the source of growth. Sustainable, valuable growth comes from expanding into new and growing markets or creating genuinely innovative products, not just aggressively battling for market share in mature industries. For personal development, seeking out new and growing fields can be more rewarding than fiercely competing in a saturated niche. Practical example. Consider the differing growth paths of Walmart, a physical retailer, and eBay, an online auction house. Walmart's growth, while impressive for decades, eventually slowed down because its expansion required building physical stores and hiring large numbers of people. Its core market is vast, but growth is inherently constrained by physical expansion. eBay, as an online platform, experienced incredibly rapid growth early on because it could add millions of users with very little additional physical investment. However, its core addressable market is much smaller, and it reached maturity much faster than a physical retailer. Lesson: for your own career, pursuing growth in a field that allows you to scale your impact with minimal additional investment, like leveraging your skills through technology, can lead to rapid early growth. However, recognize that even in digital fields, the addressable market might still have natural limits, and sustained high growth for decades is exceptionally rare.
The main idea of the book. The central premise of valuation, measuring and managing the value of companies, is that corporate value is fundamentally driven by a company's ability to generate free cash flow at rates of return that consistently exceed its cost of capital. Sustainable value creation is a long-term endeavor, achieved through strategic deployment of capital into opportunities with strong competitive advantages, leading to high return on invested capital, ROIC, and valuable growth. The book emphasizes that market valuations ultimately reflect these underlying economic fundamentals, urging managers to focus on substantive value creation rather than superficial accounting metrics or short-term market pressures. Understanding and acting on these core principles is essential for sustained business success and for effective decision-making in any market environment.
If you enjoyed the content, please consider supporting the author. Thanks for watching, and if you like this video, subscribe. Now, let's go to the next video.